Capital structure theories, traditional theory and Miller and Modigliani, theories. Capital structure theory examines how the mix of debt and equity financing, gearing, affects a company's overall cost of capital and value. The traditional theory suggests that an optimal capital structure exists where the weighted average cost of capital, WACC, is minimized and firm value is maximized. Initially, adding debt reduces WACC because debt is cheaper than equity and interest payments are tax deductible. However, beyond a certain level of gearing, financial risk increases significantly. Shareholders demand higher returns to compensate for this risk, increasing the cost of equity and eventually raising WACC. Therefore, according to the traditional view, the relationship between gearing and WACC follows a U-shaped curve. The Modigliani and Miller, theory without tax argues that capital structure is irrelevant in determining company value in perfect capital markets. Under this model, investors are assumed to operate in a world with no taxes, no transaction costs, and complete information. Because investors can replicate corporate borrowing through personal borrowing, the firm's value depends only on its investment decisions and underlying business risk rather than its financing structure. As a result, the WACC remains constant regardless of the level of gearing. If a company changes its capital structure, investors can adjust their personal leverage to achieve the same risk-return profile, leaving firm value unchanged. When corporate taxation is introduced, modified their theory and concluded that increasing debt can increase company value because interest payments provide a tax shield. This reduces the effective cost of debt and lowers the WACC, theoretically encouraging firms to use very high levels of debt. However, real-world factors limit this conclusion. High gearing introduces costs such as bankruptcy risk, agency costs, restrictive debt covenants, and potential tax exhaustion. These additional costs offset the benefits of a tax shield at high debt levels. Therefore, in practice, companies aim for a balanced capital structure that maximizes value while managing financial risk and maintaining financial flexibility.